What's up, everybody? Wednesday, August 4th. I did a new podcast today, but I'll put it up there tomorrow after I edit it. All right, so we had some good headline trading today. All the zombies. When Fed Vice Chair Clarita, he said, well, we'll start talking about taper. You know, that'll be coming up in a few months. We may start talking about, oh, everybody went crazy. All right, gold was up, the dollar was down, stocks were up. Well, not the Dow, but, bonds were steady. And then as soon as he said that, like, we'll talk about the taper coming up in a few months. We'll start to discuss that. Like, everything flipped around. Gold went down, and the dollar went up, and stocks cratered, and bonds went down, and folks, how many times do we have to see this? You remember back when back in May with the Fed, that Fed meeting, when the dot plot came out, and then you had the FOMC members now saying, hey, we think we're going to raise rates at the end of 2022, like more than a year away from now. Like these guys, this is like a forecast. Like these guys, they don't know any better than anyone else. And I guarantee you, and I talked about this in my podcast, if you took any one of those guys, those FOMC members, or any economist, basically, like, I've been a trader, okay? I've been a member of 4 exchanges. I've been managing money. I'm also an economist. But if you took any one of those guys, I'm telling you right now, and you set them up with an account where they had to trade off their forecasts, they'd all be broke. But anyway, remember that meeting when they came out with the dot plot. And up until that meeting, everyone thought, well, we got all the way till 2023 before a rate hike. And when that happened, like, everything went crazy. They sold stocks down, the dollar shot up, gold crashed, bonds tanked, rates popped back up. I said back then, like, you can go back and look at that video, and I said, that is just, you got to go against that. That's another one of these crazy zombie emotional reactions. Now, frankly, I love that because, that's like they're writing checks to me. I talked about that yesterday. Had another one of those things today. He says something. Look, here's the thing, all right? When the Fed is going to raise rates, or when the Fed is going to, taper, they're going to tell you, like, I don't understand really all this speculation about when the Fed's going to do this or when the Fed's going to do that. This is all just useless guessing, because the Fed, not only are they going to tell us when they're going to do that, but that just by telling us when they're going to shift policy, that in itself accomplishes most of their goal. Like, if the Fed wants to raise interest rates, and if it says, what are we now, in August, and if it said, like, okay, in October we're going to raise rates, rates would gravitate almost immediately towards whatever that rate hike is going to be and whatever that new rate represents on its own. They wouldn't even have to lift a pinky, all right? So it is in their interest to say. So I don't understand all this kind of useless speculation about when they're going to do this and when they're going to do that. Just wait. And wait until they do something. And then the best part about it is when they do something, 99% of the time, the market reaction is going to be wrong. And not just for the day. It'll probably be wrong for the longer term, because, again, we get back to this situation where the understanding of policy and the impact on the economy and the financial system is largely wrong, because people are just completely out of paradigm when it comes to their understanding of, the financial system and how it works. Think about it. Think back to March with all these predictions about soaring interest rates, about skyrocketing interest rates because, inflation, hyperinflation. And I said back then, this is all going to be wrong. So today we had another one of those reactions from Clarita. And you'll see, today was a day to go against that. All right. Stocks, the Dow was down. Look, we're in another one of these kind of environments where you got the surge in the virus cases. So you're seeing the NASDAQ stocks doing well, right? Because that's what we had during the pandemic. NASDAQ stocks doing well, online stuff, all that kind of stuff, threats of maybe more lockdowns, that sort of thing. Industrials were weak. Fiscal flows are good. As a matter of fact, they look like they're re-accelerating, although I think some of that is really a little calendar situation that I'm going to see tomorrow what the reality is, or over the next couple of days. But I can say this, they're not decelerating. The flows are not decelerating. And there's enough in here now to sustain the kind of environment we have right now in terms of financial markets. Also, and I don't know if I mentioned this, but the banking data was really, really strong. You're having really good loan growth now, particularly in consumer loans, real estate loans in the latest bank data, which covers the week through July 21st, I believe. Very strong rebound in residential real estate loans. So you have maybe the beginning of a new credit impulse. All right, that's something to keep in mind. And I think that says two things. Number one, it says, that is potential support, ongoing support for the economy and economic activity. And number two, it is a reflection of improved credit demand. All right? Now that usually happens when the outlook is positive, when the outlook is optimistic. Hopefully we don't go into another one of these lockdown situations. But again, all that would mean, if you think back to the lockdown, last year, the lockdowns last year, it just shifted sectors, it shifted focus on different sectors of the market. And what I just alluded to, or what I just mentioned, was we're getting a little bit of a hint right now of that happening again, where the NASDAQ and tech stocks are outperforming. Like NASDAQ was up today, Dow was down, S&P was down. I want to talk a little bit about the EIA report. A little bit of some bearish developments in there, but I wouldn't say very extreme. First of all, we had an increase in crude inventories. It was like the first increase in a while, and it was a fairly large increase. I think it was like 5.3 million barrels or something like that. Decline. Oh no, sorry. The gasoline was down 5.3 million. Crude was up. I forget what the figure was, but it was like the first increase in a while. Distillate was up a tiny bit, a fraction, like 0.8 million barrels. Gasoline demand was up. Refiner inputs were up marginally, but crude exports were weak. Quite weak, I have to say. So, on the crude oil side, I would say the fundamentals turned a little bit softer. On the product side, decent product exports. Product demand is still pretty good. So it was kind of mixed, I would say, leaning a little bit towards, a softer outlook, at least for the next week or so. And we'll see if that increase in oil inventories is the beginning of some kind of trend. We have to stay focused on that. Don't forget, I think you're getting, OPEC is raising some output. But gasoline inventories are still very, very tight, and gasoline demand is still strong. So that's good for refiners. Okay, margins are improving. So anyway, I look at today, this sell-off, I think, is an opportunity. Fiscal flows, to me, they're just saying status quo. We're going to stay positive here. I don't see a whole lot of bullishness out there. You know, people are on a hair trigger wanting to sell. Little bit concerned about the COVID situation. Be nice to see that thing peak out with these new cases that are popping up with the Delta variant. That's no good. And we don't want new lockdowns. But again, as I said, as far as the market is concerned, remember, I'm separating this out. I'm talking about the market. As far as the market is concerned, it would merely represent, I think, a shift in sectors in the market. That's how it's going to play out. Anyway, that's it for today. See you tomorrow. Bye.